Hi, I am Siti Junaida from Group 11. In our group, we have selected several companies for the study, which is Ajinomoto Malaysia Berhad, RHB Capital Berhad, Borneo Oil Berhad, and Iron Malaysia Berhad. In all four companies, we have made a combination of Ajinomoto Malaysia and RHB, Ajinomoto and Borneo Oil, RHB and Aeon, Nestle, RHB and Borneo Oil. From the combination of companies we study, we have choose combination of RHB and Aeon company because the standard deviation is the lowest among the others. Standard deviation for the RHB and Aeon is 0.039935501, while Ajinomoto and RHB, Ajinomoto and Borneo Oil, and RHB and Borneo Oil respectively with total 0.04641 5376, 0.071 688 and 0.079 201 543. Next is beta. Beta is a measure of volatility or systematic risk of a security or portfolio compared to the market as a whole. In this study, we have find the beta each combination, which is Ajinomoto and RHB, is 0.109842. Ajinomoto and Borneo Oil is 0.072283. RHB and Borneo Oil is 0.16866, and RHB and Aeon is negative 0.0536915557. Now we go to background of RHB Capital Berhad and Aeon Malaysia Berhad. RHB Bank was established in Malaysia as public company as DCB Holdings Berhad and was listed on Bursa Malaysia as the main board. After that, DCB Holdings Berhad was replaced name of company to RHB Bank Berhad in 1994. RHB also is the largest financial service group. RHB is multinational financial service firm dedicated to providing customer with complete solution by providing several sectors and enabling a simple, efficient and seamless customer experience. In RHB, there have been structured into 5 business pillars, that is Group Community Banking, Group Wholesale, Group Sharia Business, Group International Business and Group Insurance. Next is background of Aeon Malaysia Berhad. Before Aeon name, initially the Aeon name is Jusco or Japan United Store Company. Jusco led their company in Hermiger in 1969. After that, the corporation was renamed Aeon in 1989. In 1984, the firm proposed to focus on Malaysia and was accepted by Malaysia government. Aeon target the middle income group, residential families as its main customer, and provide good quality at affordable price, equipped with goods, food, entertainment and service for its customer. Aeon goals have never changed as it has adapted to meet the changing demands and wants of customer.
Next is the stock price for RHB Capital Berhad and Aeon Co Berhad. The stock price indicates its current value to buyers and sellers. The stock's intrinsic value may be higher or lower. The goal of the stock investor is to identify stocks that are currently undervalued by the market. we can see here at the table 1, which is the stock price for RHB Capital Berhad and Aeon Co Berhad in the year 2021. We can see we can conclude that the stock price RHB is higher than the Aeon. Next is the variable stock. Variable stocks have 5, which is mean, variance, standard deviation, covariance, and correlation. Firstly is the mean. Means the average of return for both companies. And next is the variance. Variance calculated by taking the average of square deviations from the mean. And next is the standard deviations. The standard deviation is of a dataset reflects its deviation relative to its mean. The square root of the variance is used to compute it, determine the risk of the both stock. Next is the covariance, used to assess the connection between two random variables. And next is the correlation. Correlation explains the degree of a link between two variables as ranging value from negative 1.0 to 1.0. Next is the portfolio returns. Based on the table 2 above, first calculate the return of these two stocks. The formula for calculating the stock return is the percentage of the month's share price divided by the previous month share price and minus 1. The share return for RHB in month 2 was 8.29%, while the share return for Aeon also used the same formula and gets a return of negative 2.13%. Second, calculating the mean formula is the average return of RHB over a period of 12 months and gets 1.11%, while Aeon earned negative 3.59%. In addition, the formula for spread variance, it is a measure of the spread of return over a 12-month period for RHB is 0.002, while Aeon earned 0.005. The formula for the standard deviation is the square root of the variance of RHB gets 0.0042, while Aeon gets 0.072. The covariance formula is by multiplying the correlation between two random variables by the standard deviation of each measurement variable between RHB and Aeon shares. Covariance for RHB and Aeon is negative 0.002. If the negative covariance means when one variable is high, the other tends to be low. The formula for correlation is the normalized covariance, to say between minus 1 and 1. There is a negative correlation between RHB and Aeon is 0.09. A complete negative correlation indicates that two assets are moving in opposite direction. RHB and Aeon the returns are included in the portfolio. The portfolio returns for RHB Capital Berhad and Aeon in the second month were 3.08%.
Next is creating an efficient portfolio. Creating an efficient portfolio creates efficient boundaries. An efficient boundary is one set of investment portfolios that are expected to provide high returns at certain level of risk. This portfolio is said to be efficient if no other portfolio offers a high return for a lower amount of risk. This is because the portfolio is located on an efficient boundary depending on the risk tolerance level of two companies. As we can see here, this is the efficient portfolio. An efficient portfolio is to adjust the weight or percentage of each share in portfolio. The proportion of RHB Capital Berhad and Aeon Company Berhad are different. So 10% of the stock of RHB Capital Berhad, while you are 100% for Aeon Company Berhad. Based on the figure above, efficient frontier, a figure that plots the expected return on the average return on the y-axis and the standard deviation or measure of risk on the x-axis. It demonstrates portfolio risk and return exchanges and helps us visualize efficient portfolios, global minimum variance portfolios, and non-checkable portfolios. And lastly, the most efficient portfolio is value of negative 0.19%. This is because this value is better than all the values below it and has a higher return for a lower level of risk.